Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. I'm your co-host, Joel Alconin, along with Spencer Israel, and we have Dr. Mikhail Melnik on the line. He's a Bloomberg economist, and he's also an extraordinary teacher, associate professor of economics at the Cole College of Business at Kennesaw State University. Dr. Melnik, how are you doing on this Wednesday morning?
I'm trying to wake up. So, how are you?
Okay. All right, here. Late night last night?
Well, if you want to watch the news, then you have to stay up late, right? Because, remember, it's morning in Europe when it's really early morning here, right?
Right. Okay. All right, getting on to some topics here. Some interesting topics, including the Fed outlook. Boy, oh boy, I mean, what do you think? Are these rates definitely going up here in December?
Definitely. Oh, I would never use the word definitely when it comes to anything related to our current Fed. I think I mentioned this to you in one of the interviews before. When I was a PhD student at Boston University, one of my professors used to say that as an economist, you should always begin any answer with the words "it depends." So definitely it doesn't apply in economics. But going back to the interest rates, I actually believe no, they will do nothing. My opinion hasn't changed. I believe that the Fed will likely do nothing this time, and any rate increases probably won't be coming until late spring. But if I were in charge of the Fed, I would probably increase the rate by very little in December. In fact, I don't know if I would actually announce a 0.25 percentage point increase in the rate, or if I would just create some sort of a flexible corridor for myself to go to that number and basically maneuver. But so I would do that, but I think the current Fed is too concerned about the impact a rate increase might have on certain financial markets, for example, the U.S. stock market and the commodity markets. And so I believe they will remain very cautious and continue with the current course. And the only thing that could possibly move them out of that path or justify this would be a very strong November labor report, similar to the one we saw in October. See, the October labor report was a surprise. And if we see another surprise like this, approaching 300,000 in November, then, of course, that would start together with the inflationary data, because if you look at the CPI for October that was just released, it was 0.2, so 0.2 for the overall index, 0.2 for the core index. So we're starting to see that 2% inflation sort of appearing, and in some areas of the economy, the usual culprits like the housing, healthcare, and food, we're already there. So basically, if the labor report is very strong, that will increase the odds, but the odds of a rate increase. But I personally believe that the October labor report was a weird jump, and I think it won't repeat itself. In fact, I think that the November labor report will come out surprisingly weak, closer to the September numbers. And if that happens, then once again, that will create more caution on the Fed's, on the Fed's side.
So, Doctor, I'm curious. The Fed, after the last meeting, they hinted that they would raise rates following a strong report, which is exactly what happened. And the consensus seems to be that they're going to raise the rates. So, you're the first person I've heard that doesn't think they will. So, I just kind of wanted to. Can you elaborate on that a little bit more?
Sure, of course. Well, let's look at this, right? I mean, first of all, statements coming out of the Fed, right? And everyone believing that they would, kind of thing. If you followed the Fed statements over the past year, you would have noticed that there were many statements that indicated some sort of an interest rate action on their part.
That's true.
And then, continuously that got postponed. So the Fed is actually doing the right thing. They're responding to the economy. Now, if one strong labor report is a good number, but it's not enough, let me give you kind of a bigger picture. The GDP growth in the third quarter slowed down. 1.5% was not an extremely great performance. However, the GDP numbers are also not that bad because about 1.4% drop in the GDP growth was due to inventory depletion. And that usually is a small rebound in the next quarter. So actually, all else held constant, if the economy does not continue to deteriorate, we're actually going to see a little bit of that inventory positive contribution potentially in the fourth quarter. That's a positive thing. However, if you look at the overall manufacturing sector, the situation there is rather soft. Our inventory to sales ratio is the highest since the middle of 2008. So only in 2009 did we see higher inventory to sales ratio briefly, and that was actually because we had a severe recession. So there's been this inventory build-up, and yet the retail sales failed to catch up with it. So the manufacturing sector is relatively soft. You see this in many indicators. The dollar remains relatively strong. A rate increase would immediately cause the dollar to edge higher. The price of oil is around $42. A rate increase would cause that to decrease. Now, that might help the United States geopolitically, but I don't know if that's needed economically here. And at the same time, if there is an increase in the interest rates, that could significantly impact the nation's financial markets. The United States economy at this point is addicted to low rates. And there is one more interesting thing. If there is a rate increase, what that rate increase will actually do to the yield curve. And this is why I argued a couple of months ago on your show that I would personally raise the rates purely because it seems to me the market, the bond market, is getting out of alignment with the reality, the economic reality. One of the key engines of growth over the past several months, in fact over the past several years, has been the residential housing market. And right now what we're seeing is a yield curve that is steepening, which hurts the housing market. We're seeing mortgage rates rise along with the 10-year bond. And if you look at the 30-year bond, well, the rise has been even more severe. So if that continues, then yes, somebody has to bring that into alignment, and the rate increase probably or some symbolic action is needed. But if that doesn't continue, and if the labor report for November comes out to be softer than people expect, then it won't continue. There is really no need for that action. So the economy is not as strong. I mean, just look at the greater landscape of the U.S. economy. The dollar remains strong. We see the effect already on the exports sector. The commodity prices, when it comes to the industrial commodities, are relatively low. Lowering them further is not all that necessary at this time. So one of the key engines of growth is the housing market. If we start really moving on the interest rate front, wouldn't that scare that market? The stock market is relatively fragile. It's been one of the wealth effect generators, and if there is a meaningful change in the policy standing, it might hurt that market. So it seems that the Fed has a lot of caution embedded in this. So that's why it seems to me that the December odds really pinned down on the November labor report. If that one is strong enough to justify it, if that one is strong enough, the 30-year bond yield will start rising, and at that point, something will be needed to flatten the yield curve and will be affordable. But if the labor report is not strong enough, which I don't expect it will be, given the fact that non-residential investment took a small dive in the third quarter, then the justification will be missing, and I think we'll get another caution statement.
Before we let you go, Dr. Melnik, we had Peter Schiff on last Friday, and not only does he think that the government, that the Fed should not raise interest rates, he thinks that the economy is in a very precarious state, and if anything, we need another round of QE before we see rates increase here. He talked about a lot, the false job number, a lot of layoffs coming in the economy. You got to imagine with some of the way these retail stocks have been hit lately, you could see some layoffs in that sector. What would be your response to that?
Well, first of all, that means I'm not the only one, right? Who's on that side of the picture, right? Who's saying those things are not as peachy as, to use the Georgia terminology, we're a peach state, I think, as people think. Well, first of all, we live in a very weird world. The Fed has messed up things pretty interestingly. Let me kind of give you an idea. If the Fed raises the rate, the federal funds rate, right, it will sort of act like a QE in a sense. But it will be a misplaced QE. In other words, it will take money out of the debt market, but put money into the pockets of banks. Because the Fed is already paying interest to banks, and that interest rate is directly tied to the federal funds rate. At least that's the current policy standard. Now, do I believe we need a QE in the traditional sense that Bernanke created us? In other words, print money, buy bonds, and see what happens. No, I don't think we need a QE. One of the big problems, the economy is weak. I agree with that completely. It's not as strong as people think, and the reason it's weak, by the way, is the Fed and is the federal policies. It's not the economy itself that's weak. We have created, the Fed has created too much uncertainty in the picture. That's why there are these debates about whether we should create some form of a monetary rule or audit the Fed. The Fed has contributed to this uncertainty. Look at us today, right? I'm an economist. You're a business reporter. And instead of talking about the economy at large, instead of discussing the various financial, and real economy sectors, we're discussing the Fed because that's really the key determinant now. We no longer pay attention to the economy. We don't care that the Empire State Index is posting negative growth now for several months. We don't care about those things. We don't care about the real economic picture. All we care about is the Fed because that's what determines the stock market, that's what determines the bond market, and that's what affects everybody. This is the wrong reality. We now have an additional layer of uncertainty coming in. We're paying attention to, we're trying to predict the behavior of a group of people rather than trying to pay attention to the economy and focus on that. We're interpreting how that group responds to the economy. So that uncertainty should diminish. I don't blame the Fed, actually, believe it or not. I believe that the Fed has become sort of entrapped by its own past policies and by the size of the national debt. So that's why I believe that the real economic problem comes to us from the federal government. In essence, we live beyond our means, and that's a serious fundamental flaw. But I think that money printing at this stage in the game will only stimulate the equity markets and the housing market and create a further unstable situation. Like, for example, why are we worried about the 30-year yield today? It's not that bad. The 30-year bond is just a little above 3%. From a historical standpoint, it's not that bad. But if it goes up to, say, 3.6, 3.7, which is still relatively low, be aware the housing market will probably crash.
We've been at Dr. Melnik. We're running up against the clock here. We've been on the line with Dr. Mikhail Melnik here. He's an associate professor at Kennesaw State University at the Cole College of Business. Thanks a lot. We'll be following your predictions here, your outlook for the market. Thanks for coming on. We'll talk to you again soon.
Well, thank you for having me.